Our guest expects market volatility under Trump 2.0, especially in the first half of this year. But he still does like, broadly speaking, US stocks. We're joined by Denis Taillefer, portfolio manager at Caldwell Investment Management. Denis, it's great to see you. Thanks very much for coming on the show.
Thanks for having me, Andrew.
We know we're going to get headlines, some of them inflammatory over the next few months, but generally you think the case for US stocks remains strong?
Yeah, we do. As much as we think, Trump will create that chaotic environment, which is what he kind of likes to do, the markets don't necessarily like that, and that does create a lot of inflation or a lot of volatility. And we've seen that under Trump 1.0, so we kind of know what to expect from a headline standpoint. But having said that, a lot of the policies they're bringing up to the table, from a cutting down or easing taxes, and then bringing down the amount of regulations, easing that regulatory burden on companies, that should have some real positive growth impacts for the U.S. economy. So we think overall the policies they have in place will help kind of spur the U.S. economy, and it's been the strongest economy globally, and we believe it will be on a go-forward basis as well.
Themes that you like, that you think could produce profits for investors include AI. You're not concerned that some of the euphoria, some of the optimism will evaporate?
We think it's still fairly early days in the AI story. Now, there are some stocks that have run really, really hard, and valuation becomes a little bit hard to kind of wrap your head around. But we still think there's a lot of opportunities through that whole AI theme. But like we said, there's a lot of strong themes right now that we do like, AI being one of them. That whole reshoring of manufacturing, we think that still has some tailwinds. We really like automation on the back of that. The only way you can really bring in more manufacturing into North America, given how tight our labor markets are, means you will have to invest in a lot of automation. Automation is an area we've liked for several years, even prior to the pandemic. It's an area that we were looking at closely because we believe it was hitting that inflection point where a lot of the manufacturing decisions that were being made, you can start to look at your options between manufacturing it overseas or doing it locally with more automation. And so that cost dynamic was starting to get very competitive. So now we think, you've got the tailwinds where you really have that demand. You want to basically diversify the supply chain, bring more manufacturing to North America. Automation is going to play a big part. So we like that theme a lot. And there's other themes as well. Obviously, the AI creates a very strong theme, we think, on the power generation. So building out the power grid and so forth. So there's a lot of different themes that have a lot of tailwinds that we think are still very early days, which is really one of the key factors. So yeah, valuations have run up somewhat, but we have quite a few years of very significant capital spending behind these themes. So we think those are probably good areas to invest in.
We've seen this big run-up, speaking of energy, we've seen this big run-up in some of the electricity generators, Constellation Energy, for example, CEG. Without commenting directly on Constellation, but do you still see people putting money into electricity providers?
Well, the providers have had a good run. Gotten a little more expensive. We haven't played it from a provider standpoint. We are playing it more from a engineering standpoint, from a construction standpoint. So we do have some exposure to the actual build-out in the U.S., as well as some Canadian names that we'll speak to on, I believe, a little later. But we still like that whole theme of having to build out the amount of power generation demand required for your semiconductor industries, for remanufacturing North America, for the AI build-out. The AI, the amount of energy required for AI is quite staggering, actually. So so we really think that we're in early days of having to really build that out. We've really seen those growth projections for energy demand really change quite a bit in the last 9 to 12 months. So we're seeing much higher growth rates in that energy demand. And so like I said, we think this is a multi-year theme, and there's different ways of playing it.
Broadly speaking, just on energy, there's a perception that Donald Trump will not be great for renewable energy. He made a rambling speech the other day. He repeated his criticisms of wind energy. Would you avoid clean energy stocks right now?
No, we wouldn't. There's going to be more volatility. Again, Trump 2.0, he likes to create that chaos, that volatility. But if you go back to Trump 1.0, the green energy did very well. There was a lot of investments in green energy in some red states. Texas has been one of the states that's invested the most heavily in green energy under Trump 1.0, under the Biden administration, and we think that will keep going. You know, the politicians like to make a lot of noise and say a lot of things, but in the end, you know, we tend to follow where the money is going, and we think there's still quite a bit of investments that will be done on the green energy side. You know, having said that, though, you know, you have to expect, I think investors have to be willing to live with a little more volatility in their investments over the next few years. So really still focus on what you think are really good growth prospects and businesses that will grow over the next few years. But you'll just have to live with that volatility, headline volatility that will come with it, that we'll have time to deal with for, you know, over the next 4 years, actually. Yeah.
We have